Welcome, G-Traders. You are watching a recap of the Asian session. Asian stock indexes climbed while the US dollar hit a two-month low ahead of inflation data. The yen rose versus its main rivals, reaching a two-month high against the greenback. It's a win in luster with investors. The movements of the yen and the greenback will depend on the US CPI data. It will help traders grasp whether the Fed will keep raising rates. This is why they ran now cautions before the release of a crucial macro stats. Speculators have already digested Fed policymakers' comments. Most of them stressed that more rate increases are needed given the level of inflation. However, they also hinted at the end of the monetary tightening cycle. Fed officials are sure to take notice of inflation figures. Yet, this report will be published too late, so it will hardly impact the Fed's rate decision in July, and the probability of a 25 basis point rate increase totals 92% according to the CME FedWatch tool. However, traders are not sure about further rate hikes. The next Fed meeting will take place on July 26 and 27. The regulator could change its decision only if inflation drops markedly. Analysts expect interest rates to be hiked by at least another 50 basis points. If the core consumer price index is in line with the forecast, the likelihood of a rate increase in September and November will be low. The MSCI AUD Japan index rose by 1.2%. The Australian stock index also grew. New Zealand shares remained unchanged on Wednesday, however the Nikkei index fell by 1%. The yield on 10-year Treasury notes tumbled by 1.6 basis points. A decline occurred after the yield reached an 8-month high on a Friday. And Chinese stocks dipped by 0.14%. The Hang Seng index started the trading session with a 0.5% increase. China's central bank extended until the end of 2024 some policies in a November rescue package to shore up the real estate sector. Markets are expecting more stimulus to be rolled out soon. However, China's stock market may start a steady rally only if more stimulus measures are adopted. The US dollar extended its losing streak, declining by 0.3%. It settled below 101.60, indicating a bearish reversal. It's also deepening ahead of inflation data. Consumer prices are projected to ease to 3.1% in June after a 4% rise in May. The greenback has been facing bearish pressure for the whole month despite positive economic reports. GDP growth in the second quarter stood at about 2%. And the housing market has recovered significantly, and the labor market remains tight. At the same time, the European and China's economies are showing signs of a slowing down, which is reflected in the manufacturing sector and businesses' surveys. Despite this, the US dollar cannot take advantage of these reports. Forex traders are now making positions based on the difference in interest rates, not paying attention to economic indicators. As a result, the US dollar has fallen sharply this week, following a steep decline in US bonds. Other currencies are climbing beyondly amid the weakness of the US dollar, especially the pound sterling and the yen. The yen gained momentum thanks to this factor. Besides, the yield of US Treasury notes dropped, while in Japan government bonds rose. Growing inflation and wages in Japan have prompted traders to believe that the Bank of Japan may revise its yield curve control. It impacted the bond market and led to volatility in the dollar-yen pair. Analysts doubt that the Bank of Japan will tighten monetary policy on July 28, yet some traders assume that expectations of a hawkish moves could trigger a further recovery of the yen in the second half of July. At the start of the week, the USD JPY pair broke through the support level of the bullish channel and consolidated below it. It increases the chance of a bearish scenario and a downward movement to 139.20, and the yen is already a step away from this target level. It strengthened by 0.6% in Asian trading, reaching the level of 139.60. For further growth, the yen needs to drop below 141.40. In the case of a breakout, an upward correction is possible. Philip Lowe's speech was in the spotlight in the Asian session. He revealed the biggest shake-up in Australia's monetary policy, and he said that the rate-setting board would move to 8 meetings a year from 11 now, beginning in 2024. Now the meetings will last for 2 days, providing deeper discussions and more time to consider strategies and risks. Lowe noted that such an approach would allow the board to study all the challenges more thoroughly and have deeper decisions on a monetary policy. He also pointed out changes in the meeting announcements. They will now be announced by the board, not just by the governor. Press conferences are planned after each meeting to explain the decisions. As for the outlook for key rates, further tightening may be required to return inflation to the target level. The Australian and the New Zealand dollars advanced against the US dollar in the morning, and traders seemed to ignore the dovish signals from regulators. The AUD USD pair tried to go to 0.6750, but then retreated. The price is expected to move in a narrow range in the near future. The impact of the interest rate gaps between Australia and the United States has led to an increase in the Australian dollar in the past few months. The Reserve Bank of Australia is projected to be more cautious when making rate decisions, as inflation is likely to return to the target range only in the mid-2025. Markets have already factored in a possible interest rate cut by 30 basis points by the end of 2024, so concerns about economic expansion may not have a significant impact on the short-term interest rates in Australia. China's economy is recovering at a slow pace, and prospects for Australia's exports are rather grim. It may affect market sentiment and put pressure on the AUD-USD pair. Given the current situation, unfavorable fundamental background, and the Fed's ongoing tightening, the pair may be unable to pick up a clear trajectory. The Reserve Bank of New Zealand has announced that it will keep interest rates unchanged, and the regulator also said that at the moment it sees no reason for further tightening. The Reserve Bank of New Zealand said in a statement that if interest rates remain at a restrictive level for some time, inflation will return to the target range of 1 to 3% per annum. Traders lowered expectations of a further policy tightening after the meeting, and the chance of an increase of 25 basis points is now estimated at about 50%. However, officials made rather laconic comments indicating that the decision had been made rather quickly. It seems that almost all policymakers voted for opposing a tightening. Lots of things could happen before August. Analysts do not rule out the possibility of another increase to 5.75%. More crucial economic data will be released. Inflation figures for the second quarter and the report on the labor market, which is on a tap on August 2. The data will provide more clues about the core inflation. After the rate decision, the New Zealand dollar was moderately volatile, and the yield of New Zealand government bonds declined after the Reserve Bank of New Zealand kept the key rate at 5.5%. Despite the dovish comments, the NZD USD pair soared to 0.6239, its the highest level since June. It appears the Kiwi could start a strong rally in July. And that's all for now. Watch InstaForex TV channel and have the latest market news at your fingertips. And see you soon.